One thing that I believe a lot of traders do tend to get wrong, not so much in the early stages, but in that middle break-even stage, is that they believe that complexity is going to allow them to derive more profits from the market. And that complexity can come in your pre-market entry requirements and your confidences through to your trade management. They believe that more indicators, more confluences, more filters is only going to mean more edge and therefore a high propensity of deriving profits from the market. I believe, and it's a discussion I have had with other people as well, that adding complexity to your trading is the single easiest way to make it worse. So today we are going to dive into this topic on why simple trading usually outperforms complex systems. And we're going to look at it through the lens of how your brain actually works and how you're able to memorize information, particularly information that is linked to decision making, and apply it in real world scenarios, e.g., in trading. At the end of this lecture, you should have a really solid understanding. By the end of this lecture, you'll have a very solid understanding of why your most profitable trading months tend to be your most simplistic trading months, and also why you keep repeating a pattern of drifting away from this. So the brain has a hard cap on just how much working memory it can hold during a decision. George Miller's research back in 1956 put the number at around about 7, while more recent cognitive load research has actually put that number down at 4. And that cap applies whether you're solving a math problem or watching price action. It really does not care which it's going to be. Your brain can really only take into account 4 decision-making factors at once. Every single indicator, every confluence in your checklist, every rule you're monitoring in real time, all of it is going to be drawing from that same cognitive pot. The implication here being that if your system requires you to hold on to 7 different things in your head all at once, you are not going to be able to execute any of them accurately. And therefore, you're going to really struggle to go and follow your rules and have any real confidence when you're trading. What this means what this means in trading is that you don't necessarily have an edge problem. What you may actually have is a cognitive bandwidth problem. You're trying to make too many decisions all at once because you have too much information to use to make said decisions. Strip it back, simplify it, and your trading will improve drastically. Most traders, when they hear simplicity, they purely think about their charts and their indicators. In reality, what you do outside of the charts and away from your desk is equally just as important to keep it simple. But that is something for another lecture. And today we're purely going to focus about what you do when you're sat down at your desk. So there's 4 main pillars that we're going to discuss here. Number 1 is your entry criteria. If you have too many confluences, you're simply going to hesitate and not be able to go and execute, whether it be entering trades, closing trades, or managing your trades. An extension of that is also your trade management, which is our second pillar. If you have multiple take profits, layered break even triggers, controlling trailed stops, every single decision make, every single decision point that you have as part of your confluences and your rules is another part of your mental bandwidth being taken up. Fewer decisions during the trade mean there's fewer chances of anything going wrong and less for you to go ahead and do. You want to be at a point with your trading that once it is entered, you can simply set the alarms and wait. When price reaches XYZ point, I know I do this. When it reaches this point, I know I do this. It should be very simple and straightforward. It should be completely binary. There should not be any wiggle room or anything that, particularly for any emotional bandwidth that comes with that trade management. The third pillar is your pair selection. Watching 10 different pairs every single day, that is going to take up so much mental bandwidth. If you think of the mental bandwidth it takes to look at one, 2 pairs is doubling that, 3, tripling that, so on and so forth. And finally is your session selection. If you're trying to trade three different sessions, you're not necessarily going to have three times the edge or derive three times the profits or even make three times the money. What you're actually just going to have is a third of the mental bandwidth as you would in having in one session. I remember when I first started trading, I had my watch list down on TradingView and I think it was around about 22 to 23 pairs all at once. I would sit down at 7 a.m. the day I was going to start trading, and I would do my watch list as your sort of the education told you to at the time. And there was at times where I had every single pair looked like it might have something setting up. And the sheer number of alarms that were dinging at me throughout the day was completely overwhelming and impossible to keep up with. And while you go and think, oh, if that alarm goes off, I'll just go and check it and there's nothing and move on to the next one. Try doing that 20 different times. It is exhausting. And unsurprisingly, I did not make any money whatsoever from it. But I did start to notice improvement when I dropped the number of pairs I was looking at. I went from 20 to 15. I then ended up at 10. Then I remember doing another review. This is going back several years. I remember doing another review and I found that only two of those 10 pairs were deriving around about 80% of the profit that I was making. And the rest was largely just break even and losses. So from that 10, I then went down to two. And to be fair, for the last few years, I have not changed from those two pairs. And my trading has only gone from strength to strength, particularly in comparison to how I used to be trading when I was looking at 20 plus pairs every single day, every single session. Now I know one clear objection that many people will be thinking, but think of the professional traders that have their Bloomberg terminals and they have all these different indicators and screens going all at once. This is absolutely true. One thing you have to remember of this is that each screen is simply showing one dedicated thing. On top of that, that has been monitored by a specialist who's in a team of other specialists who sit under an experienced manager, etc., etc. Institutional trading is distributed across a series of people within a team. Retail trading is concentrated on one single person, and that is you. Do not make the comparison between institutional traders and retail traders. As a retail trader, you want to try and derive the kind of results that institutional traders have, but we are not looking to do the exact same things that they do. So let's actually provide a picture here of what simple trading actually is. So on the left, you can see we have a huge amount of information here. Starting off with pairs, we're looking at several different pairs all at once. In comparison to the right, we're only looking at the two pairs. We have simplified this down to two key pairs, which are not going to take up too much mental bandwidth for us. When it comes to our confluences, the confluences on the left are the exact same as the confluences on the right. When I have to sit here and go and look at my confluences when I have an entry approaching, it's far easier for me to go and look at the one on the right than the one on the left. A simple sweep of external range liquidity can just move it down to a sweep of ERL. SMT, well, I'm only looking for divergence, so let's just call it SMT. Higher time frame bias, HTF. Everybody knows what HTF stands for, and if you don't, you're probably so early on in your trading journey that you don't need to think about this too much at this point. Secondly, a break of market structure. Simple, BMS. Regards to your entry framing, again, we keep it really, really simple. We're going to enter at an optimal 5 minute fair value gap. Our stop loss is external range liquidity. There's not going to be anything else here. There is no 50% push to stop loss to take close at break even if we come back to break even. Absolutely not. We're going to keep it simple. We're not just looking to try and get rich quick. We are in this for the long run. And therefore, we want to control our mental bandwidth, which simplicity is going to allow us to go ahead and do. Our take profit is simply going to be at 5R. Our break even at 1.5R. Now, in regards to the trade management, again, let's just simplify it down. We can shorten this considerably. Not only that, let's just get rid of some of the crappy rules that we just do not need, including that 50% push. Break even 50% trailing stop loss. Nice, clean, simple, and memorable. When it comes to your rules, confluences, and trade management, this should be something that you have memorized inside and out. You should know it so well that you could go ahead and say it in your sleep without even have to think about what it looks like on a piece of paper. Most traders hear simplicity, they think it's going to be the easy option, when in reality, it's a far harder option, but it is going to be the profitable option. It requires you to have only a handful of rules when your instincts want you to go and add another one for safety. Every single losing streak that you have will push you towards having more complexity in your systems in order to keep you safe, because that is naturally how your brain is hardwired. The mature trader has already done this loop, potentially several times over. They've added indicators, they found it didn't help, they've stripped them back, and now they're executing the same simple setup on repeat, but now have the conviction to follow through with it. That's the work here, not finding the perfect system, trusting a simple one long enough for it to become boring. And once it becomes boring, it then has the chance to become profitable. Profitable trading is boring. And one of the reasons that it's boring is because it is simple. Thank you very much for watching. I'll see you in the next one.